Good evening. Come to this wonderful IAS 8. What it is called accounting policies, changes in accounting estimates and errors. So there are three areas covered in this standard: accounting policies, change in accounting estimates and errors. Okay. So very simple standard, relatively small standard. So what we are going to learn in this standard is what are the factors you will keep in mind while selecting an accounting policy. How does the management decide what should be the accounting policy should be followed? As you are aware, change in accounting policy or a particular accounting policy chosen can have a significant effect on the presentation and disclosure of financial statements. What will be the hierarchy? Hierarchy means which one will be given priority. Will IFRS will be given priority or US GAAP will be given priority? If for a particular transaction or event, there is a provision in IFRS and there is a provision in US GAAP also, IFRS will be given priority. If IFRS is not available, then the standard will give you next what you will do, next what you will do. Okay, so that is what we will discuss. The standard prescribes criteria for selecting and changing an accounting policy. Can we change the accounting policy? The next issue is. The answer is yes, but again this standard will tell you when can you change the accounting policy and then what will be the disclosure requirement or adjustment requirement when you change an accounting policy. The standard also talks about changes in accounting estimate. That means you can make estimate, you are allowed to make estimate, but at the same time, in case if you change the accounting estimate, what are the presentation and disclosure requirement? And the standard talks about correction of errors by enhancing relevance and comparability over time and with the financial statement of other entities. So the objective of the standard is that if you apply IAS 8, it will make comparison of different financial year of the same entity possible. It will make comparison of one entity with another entity also possible and relevant. Right? Standard is very simple. It discusses three areas: accounting policies, changes in accounting estimate and prior period errors. Okay. So first topic is what are accounting policies? Accounting policies can be specific principle. An example: depreciable assets should be written off over their useful life, is an accounting principle. Inventory should be valued at cost or net realizable value, whichever is lower, is an accounting principle. Okay. Basis means measurement. Basis means measurement. For example, inventory can be valued at cost, that is FIFO, or weighted average also. So this cost or weighted average is the basis. Even that is a part of accounting policy. Okay. Accounting policies can be any convention that we are following. Like usually those items which are consumed within 1 year, they are written off. So that has become a convention. Selling and distribution expenses are written off. Rules. Some accounting policies may be affected by the rules. For example, a company may have to depreciate an asset as per the law which governs that company. Possible, right? Or it may be policies or practices which the entity follows. So what are the accounting policies? Principle, basis, convention, rules and practices which are applied by an entity in preparing and presenting the financial statements. Specific principle, basis, convention, rules and practice applied by the entity first in preparing and then in presenting the financial statement. Next is, what is a change in accounting estimate? So first, can you tell me what is an accounting estimate? Then I will tell you change in accounting estimate. Accounting estimate means approximation of an amount. Approximation of an amount due to lack of accurate information. Is it right? Due to lack of accurate information, we have to make an approximation of an amount. For example, a simple example would be the allowance for bad debt. Allowance for bad debt, or what you call provision for bad debt, is nothing but an accounting estimate. Useful life of an asset is an accounting estimate. Why do we make an estimate? Why don't we wait for the accurate information? We have to close our books of account periodically, quarterly, half yearly, yearly. Sometime you will get the exact information over many years. For example, useful life of an asset is 5 years, but that is an estimated number. Should we wait for 5 years to know exactly how many years this asset had served us? No, you can't. So therefore you have to estimate. Or for example, residual value of an asset is an estimated figure. Many times the fair value of an asset or a liability is an, to some extent, estimated figure only. So estimates are allowed so that you can finalize your books of account and prepare the financial statement. If you wait for accurate information, your preparation of financial statement will get delayed. Allowed. Okay. But can we change the estimate? The answer is yes. Change in estimate is an adjustment to the carrying amount of an asset or a liability, or the amount of the periodic consumption of an asset. So change in estimate means you are going to change the carrying amount of an asset or a liability. In case of any item, like you can say debtors, where you make allowance for bad debt. The moment you change allowance for bad debt, the carrying amount of the receivable will change. Or you measure many assets and liabilities at, say, for example, fair value. So if you change the estimate about fair value, the value of liability will change. If you change the useful life, if you change the residual value, if you change the method of calculating the depreciation, even that is a change in estimate, because that will change the periodic consumption of an asset, right? That results from, why do we need to change the estimate? Because the information that we have now is different from what we had earlier. That result from assessment of present status of an expected future benefit and obligation associated with asset and liabilities. The information that we have now may have changed compared to what it was when we had made the estimate. So present status of the information may affect the value of assets and liabilities. And then in your note it is written also, what are the reasons for change in accounting estimate? Question for you. Why do we need to change the accounting estimate? Because we may have a new information now. We might have made provision for, say, litigation expenses, but now we have a better understanding of the court case. Court judgment has been released. So can you not revise the provision for litigation expense now? You can. Or suppose earlier you had made a provision based on a prospective law. Government is bringing a law. According to that you might be affected. You made a provision. Now the law has actually been enacted in the form of an act, and you know what would be your actual liability. More information, new development. So new law, okay, settlement of a court dispute may make you revise your estimate, and accordingly underline are not correction of errors. Change in estimate is not correction of error. If you have made useful life estimation 8 years later on revised to 3 years only. Is it an error or a change in estimate? Change in estimate. You have made allowance for bad debt, which means what we call provision for bad debts, but I will call allowance for bad debt, equal to 5 lakh rupees. But actual bad debt only turned out to be 3 lakh, say for example. Is it an error? No, it will be called change in estimate. Does it make a difference whether I call it an error or a change in estimate? If it is an estimate, the effect will be given prospectively, and if it is a correction of error, the effect will be given retrospectively. So it will make an impact in your comparative figure presentation, opening balance of equity or assets and liability will be affected. So we need to make a very clear distinction between, is it a change in accounting policy, change in estimate, or is it an error? Next is material omissions or misstatements. Underline. Material omission or misstatements of item are material if they could individually or collectively influence the economic decisions that users make on the basis of the financial statement. So when is an item material? When they could individually, either singly or collectively, can influence the economic decision of the user of the financial statement. Materiality depends on the size and the nature of the omission. What is the meaning of size? The amount. Now, if you are a company with 1 lakh crore turnover, 1 lakh crore, then 5,000 rupees here or there is not a material item. Okay. But a small company may find even 5,000 rupees as a material item. Then it depends on nature of the omission also. If it is a fraud committed by the management, even if it is 1,000 rupees, 10,000 rupees, is it material? Then it can be a material. Audit fees paid, okay, under different heads is required by the law in some country. So even that is material. So materiality depends on size and nature of the omission. Materiality depends on misstatement judged in the surrounding circumstances. It also depends on your judgment. What is material is sometimes a subjective issue. Okay. So it depends on surrounding circumstances also. The size or nature of the item or a combination of both could be the determining factor. So you have to apply your judgment taking into account the size, the nature, the surrounding circumstances to judge whether it is a material item or not. As we have studied in IAS 1, material items needs to be disclosed separately. Omission may be misleading. It may influence the decision of the user of financial statement. Next is the concept called prior period errors. As the name suggests, these are the error committed in one or more prior periods, but were discovered in the current period. Now what should we do? Should we adjust the current data or should we give the retrospective effect and adjust the opening balances? Yes. So this standard guides you with respect to that also. Prior period errors are omissions from and misstatement in. It can be omission, you have not written only, or it can be misstatement, you have wrongly written in the entity's financial statement for one or more prior period, arising from a failure to use. Either you have not used it or misused it. Reliable information that was available when financial statement for those periods were authorized for issue. That means the information was available. Either you have not used it or you have misused it, not used it. A purchase invoice you have received, but you failed to record the transaction. You have received a purchase invoice for machinery. You have debited the purchase of goods account. So you have misused the information. Not used, not recorded only. Misused means it should have been capitalized under property, plant, equipment, and you have recorded it as a normal expense and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements, which means with little care, little alertness, you could have avoided this error or misstatement. Is it right? Like for example, if you do the gross profit ratio analysis and if you have not recorded some purchases, might be it will be caught there. In your inventory analysis, it will get caught. Is it right? Opening stock plus purchase minus sale is closing quantity. So if you find that there is a mismatch there, you can look at that also. Okay, you can look at the creditor account and you can find out that some purchases are not recorded. You are making payment but purchase is not recorded. So these are the ways you can trace that there is something wrong, but you have not taken normal care, usual care. Had you taken those care, this error or misstatement could have been avoided. So therefore it will be called prior period error. If the allowance for bad debt changes, that is not a prior period error, because that is based on an estimate. Okay, useful life cannot be a prior period error because that is based on error. Now example why errors are committed. Mathematical mistake, 10 into 10 2000, 1000, 10 into 10 1000. Sometime you may put a wrong formula in the Excel sheet that you use for doing the calculations, especially like calculation of depreciation or some other calculations. Then mistakes in applying accounting policies. Capital expenditure, revenue expenditure, revenue expenditure, capital expenditure, research expenditure capitalized. But then some standard will say, no, research expenditure can't be capitalized. Oversight, you have not recorded some information only. Misinterpretation of fact. Again, you can give the same example. You are not able to interpret whether it should go to capital or revenue. Fraud is also an example of error, tick mark. Fraud is also an example of error. In this standard, fraud is also an example of error. Why fraud was committed? You should have enough internal control to avoid it. Is it right? So even in a question where fraud occurred in 2014 and discovered in 2018, that is also a prior period error, and the standard will apply with respect to that as if it is a prior period error. Now next is the difference between retrospective application and retrospective restatement. Two definitions back to back. Retrospective application and retrospective restatement, are they the same thing? No. Retrospective application word we will use with respect to change in accounting policy, and retrospective restatement we will use with respect to change in or with respect to errors. Okay, because for change in estimate we don't have to do retrospective adjustment, but for rectification of error we have to do retrospective restatement. Okay, so retrospective application is applying a new accounting policy to transactions, other events and conditions as if, underline, as if that policy had always been applied. As if that policy had always been applied. Suppose in 2019 you are going to introduce a new policy with retrospective effect and company was formed in 2007. So you have to do the calculation as if this standard was applied right from, or this new policy was applied right from 2007. So go to 2007, give the effect of this policy and adjust the balance of asset, liability, retained earning, etc. and find out the opening balance at the beginning of the earliest period presented. Then you are laughing at me. We are in 2019 and if the company was formed in 2007, then it is impracticable. Then you will go to as much behind as you can and then apply the retrospective application, and if you can't go behind also, then apply prospectively also, but that we'll see later. So they have kept in mind the practical difficulty of applying retrospective. If a company was formed 40 years ago, you can't go to 40 years old financial statement and do the correction. Then go as much far behind as you can. What is retrospective restatement? Is correcting the recognition, measurement and disclosure of amounts of elements of financial statement as if a prior period error had never occurred. Now underline, as if a prior period error had never occurred. That means you have to go to that year and do the correction. So that will change the opening balances of next year, again next year, and you have to do this and bring to the opening balance of the earliest period presented. What is impracticable? One more definition. Impracticable means applying a requirement is impracticable when the entity cannot apply it after making every reasonable effort to do so. After making every reasonable effort to do so. That is impracticable. Next paragraph, when we will say it is impracticable. So they have given you 3 examples also. One general example, as I said, if a company is formed 40 years ago, then applying the retrospective application is very impracticable. Or if suppose a fraud was committed 15 years ago and now you are discovering. So retrospective restatement may be impracticable in that case. Even though you may try, but you may not have so much of information available. Employees have changed in the last 15 years. So for a particular prior period, it is impracticable to apply a change in accounting policy retrospectively or to make a retrospective restatement to correct an error if the effect of the retrospective application or retrospective restatement are not determinable. Probably you will not be able to determine it. Like for example, which we are going to discuss later also. Suppose a company now wants to follow component wise accounting for property, plant, equipment. Component wise accounting means suppose there are 10 components in a property, plant, equipment and they are significant, then they will be depreciated according to their useful life. And this was purchased long back. During this time, lot of sale, purchase, depreciation has been provided. Now, if you want to apply it retrospectively, it will be very time consuming. Lot of efforts will be required, lot of man hours will be spent on that. What management will say? We cannot give retrospective application. Calculation of the amount, etc. is very difficult to determine. Or retrospective application or retrospective statement requires assumption about what management's intent would have been in that period. 15 years ago, what management would have thought about this transaction or event? Difficult. So therefore, impracticable. One more example, retrospective application or restatement requires significant amount of the estimation, significant estimation of amount. Then in that case, the management can take the excuse of impracticability and may not apply the provision of the standard from retrospective effect. But then as an auditor or the audit committee of the company or those who are reviewing the financial statement, they will also apply their own intelligence to check management has taken all the reasonable efforts to do so. Okay. Even when you do the auditing in the companies, you have to apply your judgment and see, can it be given retrospective effect? If yes, do it. Don't only just rely on what the company would tell that this is not possible, because they would prefer to say that way. Why to again open the books of account and again do the adjustment? It takes a lot of time, and in the process you will find some more errors. Right. So they would try to avoid, but you The accountant should try to insist if it can be done. What do you mean by prospective application? Prospective application means the change in accounting policy and of recognizing the effect of change in accounting estimate respectively are made from prospective effect. Means from this point onwards. Will not go into the past. Is it right? Applying the new accounting policy to transaction, events and condition occurring after the date at which the policy is changed is called prospective application, or recognizing the effect of change in accounting estimate in the current and future period affected by the change. So don't go into the past. Current year and future period will be adjusted is called prospective application. So quickly answer, when there is a change in accounting policy, are we always supposed to give retrospective effect based on your whatever knowledge you have? The answer is depends on whether the transition provision of the IFRS requires retrospective application. If no, we'll give prospective application. So first is, if the transition provisions require prospective application, we'll give the prospective application. Second thing, as we discussed, if retrospective application is impracticable, then we will give prospective application. Change in accounting estimate is always given prospective implication or application, and similarly the rectification of error always retrospectively. Only in the event of impracticality will give prospective application. So this was a long discussion on only the basics, the definitions. Now we'll see how the standard needs to be applied. First is how to select and apply the accounting policy. It is the management's duty to decide what accounting policy should be followed. So who will decide the accounting policy choice? The management. But the standard gives a hierarchy. Hierarchy means priority wise, and you have to follow this priority only. You can't do the reverse way. The hierarchy for selecting and applying accounting policy for transaction and other event is prescribed in the standard. First thing, underline, these are all potential questions to test your understanding. If an IFRS specifically applies to a transaction, that means suppose you have purchased a property, plant, equipment, there is a IAS 16, that IFRS shall be applied in determining the accounting policy. If there is a business combination, there is an IFRS 3, so you have to apply that. Then IFRS are accompanied by guidance, not guidance note, guidance. So in IFRS, there is a concept of guidance to assist entities in applying their requirement. Okay, like you have IFRIC, SIC. So if you have any guidance, then you have to apply that guidance. All such guidance state whether it is an integral part of IFRS. Now underline integral part. Guidance note that is an integral part of IFRS are mandatory. So see the priority. First priority to IFRS. Second priority will be given to those guidance which are mandatory. Those guidance which are mandatory. Guidance that is not an integral part of IFRS does not contain requirement for financial statement. So second priority will be to mandatory guidance under IFRS. Now in the absence of an IFRS that specifically applies to a transaction, suppose there is no IFRS, some kind of transactions have taken place for which there is no IFRS or IFRS guidance, mandatory guidance, management shall use its judgment. Now the management will have to apply the judgment in developing and applying an accounting policy. But while applying the judgment, in developing and applying an accounting policy, that results in information that is relevant and reliable. While applying judgment in applying an accounting policy, choose an accounting policy that will result into relevant information. Means what is relevant in decision making for the user, and that is reliable, unbiased, trustworthy. Okay. And then the standard further gives you guidance about relevance and reliability. While assessing relevance and reliability, following factors should be considered. So what are the things the management would look into? First, whatever accounting policy they choose, it should represent faithfully, honestly, without bias, unbiased, the financial position, performance and cash flow. It should reflect economic substance of the transaction, not the legal form. It should be neutral, that is free from bias. It should be prudent, and it should be complete in all material respects or aspects, whatever. Is it right? Okay, so let us revise. First priority to IFRS. Second priority to guidance under IFRS which are mandatory. Third is management judgment. Management, while applying judgment, must ensure relevance and reliability. Relevance and reliability means faithful representation, substance over form, neutrality, prudent and completeness. Okay. For the purpose of the attribute that management shall use in developing and applying accounting policy, the following shall be considered. Requirements in other IFRS dealing with similar issues. So how do management apply the judgment? They also have to look into some other standards only. They can't create their own standard. So what they are saying, look into other similar IFRS. Like for example, you are calculating how much cost should be capitalized for PPE. You might look for intangible asset standard which also deals with capitalization of cost for long-term asset. Yes or no? Non-current asset. So similar issues. This is just an example. Then definition, recognition, measurement criteria as set out in the framework. In the framework they have given the definition of asset, liability, income, expense, etc. So keeping those in mind, you decide your recognition and measurement criteria. Third is, you can take guidance from other standard setting bodies which have similar conceptual framework. For example, US GAAP. So don't go to US GAAP directly. Okay. You can refer other accounting literature, and you can also refer the accepted industry practices. So this is for management judgment. While applying judgment, you follow this order, or not just order, you follow this entire thing as such, and then you see where you can get that information which is faithful, neutral, substance over form, complete, etc. Is it right? So I have made a small summary of the last few big paragraphs. Hierarchy. First priority, IFRS and mandatory guidance. And second is guidance which is integral part of IFRS. The same thing. And the third is management judgment. While applying management judgment, you can refer other IFRS, accounting literature, industry practice, or other standards which have similar framework. Is it right? Like US GAAP. Consistent application of accounting policy. As you know, being an accountant, accounting policies should be followed consistently period after period, so that the figures of different periods are comparable. One entity can be compared with other entity, but that does not mean your accounting policies should be rigid. Accounting policies are allowed to be changed. Accounting policies are allowed to be changed in limited circumstances only, because too frequent change in accounting policy will again remove the relevance and reliability and comparability feature of your financial statement. Accounting policy selected by an entity is required to be applied consistently for all similar transactions and other events unless required by an IFRS to do so. Only if an IFRS permits you to apply a different accounting policy, then in that case you can follow a different accounting policy for similar transactions, otherwise not. Okay. Like for example, in this standard only we will see, and in IAS 16 also we will see, for property, plant and equipment PPE, there are two models permitted: cost model and revaluation model. Suppose the entity changes the accounting policy from cost to revaluation model voluntarily. Now, if you strictly apply the IAS 18, it means you have to give retrospective effect. But this is an exception. In the standard IAS 16, if you change the accounting policy from cost to revaluation model, you don't have to do retrospective application. You have to give prospective application only. So where a standard required otherwise. Okay. So sometimes standard may say you may follow a different practice, then follow that. If an IFRS requires or permits such categorization, an appropriate accounting policy shall be selected and applied consistently to each category. So for similar transactions where two policies are allowed, again you will follow consistently. Suppose there are two similar transactions, 1 and 2. Then whatever policy you choose for this one type, you follow consistently. Whatever accounting policy you choose for this second type of transaction, you consistently follow that, subject to they are permitted by IFRS. Okay. When can you change an accounting policy? When it is required by an IFRS or it results in presenting more reliable and relevant information to the users. Only two. Change in business. Change in business will get covered in second one. It results in presenting more reliable and relevant information to the user. So if your business model has changed, you will change the accounting policy. Earlier you were giving your trucks on hire basis, on rent basis. Now you have started selling the truck only. Second hand truck sale business. So your business model has changed. So you will follow change in accounting policy because it will give more relevant and reliable information. What is not here, change is required by the law. That is not specifically mentioned here. Okay. But then you can change the accounting policy under the second clause by saying that it will result into more relevant and reliable information to the user. Even if the law changes and says that you must change the accounting policy, you can change under which pretext? Second pretext, that it will result into a more reliable and relevant information to the users. Okay. Now paragraph 6, applying changes in accounting policy. There are two situations in which we can change the accounting policy as per the standard. Change is required by an IFRS. If the change is required by an IFRS, which means either a new IFRS will be issued or there is a transitional provision in the IFRS. Is it right? Follow that. If they say retrospective, then you follow retrospective. If they ask you to follow prospective, then you follow prospective. Okay. So if the change is due to either new IFRS or amendment to an IFRS, they will give you the guidance. What will you do? Whether you follow prospective or retrospective, accordingly you follow. Okay, accordingly you follow, because some of them may ask you only for prospective application. Some of them may ask you for retrospective application. And IFRSs are continuously evolving, continuously changing. So therefore, they will mention in that IFRS. But sometime management voluntarily changes the accounting policy. In rare cases, the transitional provision may not contain any direction as to whether you follow prospective or retrospective application. So they have made it clear, if the transitional provision fails to mention about the application from retrospective or prospective effect, then in that case you'll follow retrospectively. If you voluntarily change the accounting policy, then also you'll follow retrospectively. Okay. So in general, the answer is retrospective application. Only if the transitional provision or IFRS requires prospective application, then follow the prospective application. Example of change in accounting policy. Inventory valuation can change from FIFO to weighted average. The interest which might have been written off may be capitalized or vice versa. Okay. Changing from write-off to capitalization of interest relating to construction of non-current asset. In case if we had done that. Okay. Now some examples we will solve now. After you have slept for a long time, come to the example. During 20x5, Men's company has reported depreciation in its expenses. Very good. However, the directors feel that they should split the depreciation into two parts: depreciation on factory equipment and depreciation on office furniture. Depreciation on factory equipment will be reported in the cost of sale and depreciation on office furniture will be reported in expenses. The proposed financial statements are as follows. Now you see, earlier what they used to do, only one single line item for depreciation, but they think that in case if we are following function wise classification, then why not to include depreciation on equipment in the cost of sale? That will give me a better understanding of gross profit figure. So from treating depreciation as an entire expenditure in the expenditure part, they have divided into that portion of depreciation relating to equipment in cost of sale and that portion other than that is expenses. So can we do this? Can we just change the presentation of depreciation here? Why they have changed it? It will result into a more appropriate presentation. More relevant and reliable information can be given. Now your gross profit figure will be more relevant and reliable. So therefore the answer is, can we change the accounting policy here with respect to presentation of depreciation? Yes, it will result into greater accuracy. Is the answer printed there? If printed, then there is no point. Don't write, it's printed. Allowed. Now one more question for you. When a change is not treated as a change in accounting policy. Okay. So it may look like a change in accounting policy, but it is not a change in accounting policy, and therefore retrospective application will not apply here. Okay. The application of an accounting policy for transaction, other events or conditions that differ in substance from those previously occurring. Okay. That means this new transaction is substantially different from the previous transaction. Substantially different. Example I have already given once again. Suppose there is a company called ICAI. What it does, it manufactured bags until 2005. It had 5 motor vehicles at that time, which was used for delivery of bags. So what will be the classification of this motor vehicle? Non-current asset. These are used as property, plant and equipment. However, in 2020x6, shareholders have approved a proposal for change in the nature of business from manufacture of bags to sale of used motor vehicle. ICC Limited classified all the existing 5 vehicles as current asset, not non-current asset now. That means the classification of the same motor vehicle will change from non-current to current, because now they are like inventory item during 2006, as they will be sold as a part of normal business. The change in classification will not be treated as a change in accounting policy, because the new transaction is substantially different from the old transaction. So first situation is when the new transaction is substantially different from old transaction. Okay. Second is the application of new accounting policy, other events or transactions that did not occur previously. Now for something to change, there must be some original transaction also. If there is no transaction and then a transaction takes place and you choose an accounting policy for that, it is not a change. Or if there was transaction earlier, it was of immaterial nature. It was of immaterial. For example, this example deals with a situation when you had earlier immaterial transaction, like you had only few employees, 5-6 employees. Payment of gratuity act did not apply to you. When the employee retired, employer voluntarily on his own gave some gratuity to him. And that time what they did, they just followed the cash system. Whenever he will retire, we will pay, and that time we will account it as an expense. But now the organization has become very big. There are 1000 employees. There is a formal retirement gratuity scheme in the company. So now they will do actuarial valuation. They will calculate the present value of defined benefit obligation and make provision. Do they need to apply this policy retrospectively? No. You can say this new policy is not in existence earlier. Whatever policy was in existence earlier was immaterial. Another example, 2 examples on this point. Healthcare Foundation obtains a grant for the first time. Okay. So what it will do, it will account for this transaction as per IAS 20. Okay. Accounting for government grant. Will you call it as a change in accounting policy? No. You never had a situation where you have received government grant. Now you have received it for the first time. So this is not a change in accounting policy. And one more exception there is there, revaluation of asset. The initial application of a policy to revalue asset in accordance with IAS 16 or IAS 38 is a change in accounting policy to be dealt with as a revaluation as per IAS 16 or IAS 38 rather than in accordance with this standard. This standard specifically says, if you change from say cost model to revaluation model, then even though we can call it as a change in your accounting policy, but the treatment will be given as per this 2 standard, not as per the current standard IAS 8. Next is retrospective application that we have discussed, as if the accounting policies were applied from the beginning when the transaction had occurred initially. So now what you will be doing now, you have changed the accounting policy and you have to give retrospective effect. Opening balance of each component of the equity into bracket retained earning usually of the earliest comparative period presented is adjusted for the retrospective effect. Okay. So you will go to that earlier period when the transaction had occurred, give the effect of the new policy, find out what would have been the balance of the retained earning, what would have been the balance of that asset or liability, and give the effect in the opening balance of each component of equity. The comparative and the current period transactions are presented according to the new accounting policy. So current year will obviously be as per new policy. Comparative figure will also be as per new policy. And in IAS 1 you have learnt, if you change the accounting policy from retrospective effect, one additional balance sheet will also be given. One additional statement of financial position will be given. So right from there till the end of the current year, you will give the effect of new accounting policy. Are we supposed to give the financial statement of those earlier years also? Not required. Is it right? You are not required to give those financial statement. Only you have to give the effect in the opening balance sheet that is presented. And then what about the impracticability? As we discussed, theory and practice are two different things. Theory says retrospective application. Company was formed 40 years ago. So are you going to give the retrospective effect from 40th year? The answer is no. You can't go that much behind. So the standard says go as behind as possible. Just keep this much in mind. Whatever you can do, do it. Okay. The standard envisages the practical difficulty that could arise on such retrospective application and provide certain relaxations. Okay. So what are the relaxations they have given? Impracticability of retrospective application and the concerned treatment. Impracticability of determination of amount affecting the prior period's comparative information that is presented. One is called period specific effect. Even if you find it difficult, just keep this in mind. Whatever you can give the effect in the past, give it. Otherwise, go to that earliest period to which the retrospective application can be given. Okay. Like I am in year 2020 and I have chosen an accounting policy. So retrospective effect will be given from 2002 because this transaction was occurring here also. This is not possible. Management says we can give the effect only from 2018. Okay, then you can give the effect from 2018. But of course you have to justify this in the notes. In the disclosure we will see, in case if you are not able to give retrospective application, justify in your disclosures. The new accounting policy is applied to carrying amount of asset and liability at the beginning of the earliest period presented for which retrospective application is possible. And then next is impracticability at the beginning of the current period in determination of cumulative adjustment of applying new accounting policy to all prior period presented. Because the standard says the opening balance needs to be adjusted. But for that you have to give cumulative effect of all past year. Go to 2002. Keep making correction till you reach 2020 beginning. If it is possible, do it. If it is not possible, adjustments are made from the earliest date practicable. Right? In both cases, you can just simply say make adjustment from the earliest date practicable. Earliest date practicable. And if that is also not practicable, then prospectively. What is the last thing that you can do? Prospective application. Now we'll solve problem number 1. Disclosure I will take after this because you look a little tired, so solve one question first. Okay. An entity starts a business in July 20x5. Let us say 2015. The business was small in nature and therefore the entity did not follow any specific accounting standard for valuation of inventory. Very good. Whatever you felt good at that time, you did it. over the decade. How many years are over? 10. The entity flourishes, becomes a big company and decides to apply IAS 2 on inventory from financial year 16-17. So let us call this is 2005. This is 16-17. It decided to follow the weighted average method of inventory valuation. So now they are properly applying IAS 2. Following question will arise. 4 questions are there. Shall entity do such valuation retrospectively or prospectively? So is it due to change in IFRS or a new IFRS, or is it a voluntary change? It is a voluntary change. So if it is a voluntary change, you have to give retrospective application, unless retrospective application cannot be given effect to. Okay. Then the question is, what do you mean by retrospective application? That's a theory question. Huh? But you have to write a note, na? If it is practicable, then you have records, na? You have some or the other records. So now you have to give retrospective effect. But if you can always practically say that retrospective is impracticable. But while writing the answer in the exam, write all possibilities. What do you mean by retrospective application? That you can write. If it is to be applied as if it was applied from July 2005, then what about the accounts already presented? Does entity need to change all those accounts? The entity is not required to change all those accounts. Only you have to give the effect. How would the effect be given? The effect would be given by adjusting the opening balance of inventory and retained earning. So let us see how to present the answer. So your institute says it will depend upon whether the company is following the standard as per new IFRS or it is applied voluntarily. See, you have to show to the institute that you know the entire thing, and then this is the answer for this question. Because the standard says in 2 cases the accounting policy can be changed. It won't be considered as a change in accounting policy. Something they must be applying at that time for valuation purpose. Okay. They might be following some or the other accounting policy. So what you can do, either you can take that stand in that case, that but it is over 10-year period. So don't you think that the jump will not be suddenly? Your value of inventory or your inventory figure may be 100 in the beginning and now it is 1 lakh. But in the previous year it was not 102, it must be 90,000 or something. But considering these 2 figures, these are material difference, material figures. Till last year you have not applied properly, but this is a big amount. It is not an immaterial amount. Business was small in nature here. Over 10 years the business have flourished. Business will not flourish in suddenly in 1 year, 9th to 10th year, from 100 to 10 lakh. Okay. So you can say they should have followed, but they have not done. So what you can do now? In the above case, the entity that is taking the decision to apply the standard, and therefore it will be treated as a voluntary application. If it falls under voluntary application, then IAS 8 states that policies should be applied retrospectively. If it was just say 2 years, first year 100, next year 10,000, but over 10 year your business has grown. So the difference in 9th year and 10th year, both figures will be material. As per the definition, retrospectively assumes that policy had always been applied. This is the answer of second part. It does not state any specific period. had always been applied, that the policy was applied right from the first day, that is July 20x5. Then the third question is, are you supposed to prepare all the accounts? The answer is no. Underline. You are not required to give the correct figure for all the previous figure to the investors, to the stakeholders. You will do the calculation in your office, but this financial statement will not be presented for all the 10 years. Entity is not supposed to change the accounts which are already presented. However, it needs to give the effect of change in policy while presenting the accounts for the year in which the new policy is adopted. This is our current year, 2016-17. This is our previous year, 15-16. And this will be the opening statement of financial position. So whichever we are presenting, in those we are going to give the effect of the change. In the current case, the new policy is adopted from 16-17. Therefore, the effect will be given in the concerned item in the financial statement of 16-17. And of course, if you are giving the prior figures also, comparative also, those will also give the effect. And now the next question, how the effect will be given? That is explained in fourth answer. IAS 8 state that entities shall adjust the opening balance of each affected component of the equity for the earliest prior period presented and the other comparative amount disclosed in each prior period presented. So in this example, we'll have to prepare 3 SOFP: current year, previous year, beginning of the previous year. In all the 3, we have to follow the new policy and change the retained earning and whatever inventory amount is there. And one more example, which is a continuation of the above. Continuing the above illustration, assume that company might be following weighted average method of valuation of stock right from July 20x5. In reality, company might have applied other methods like specific identification, LIFO or FIFO, etc. Company might have changed also the method during the period, as it was not following any specific standard at that time. However, now in FY 16-17, the company decided to follow IAS and accordingly decides the weighted average method of valuation. Analyze. Same question. Same question now. So same answer you have to write, that there is a change in accounting policy and it is a voluntary change, not due to change in the requirement of IFRS. So you go to that 1st July 2005 and from that day till the earliest day presented, calculate the retrospective effect. In this question, the numbers are not given, so adjust the opening retained earning figure and the inventory figure. Okay, so the answer you will write like this: the company needs to calculate the closing inventory of every year, assuming that it was following the said method from day 1. This will change the figure of gross profit, net profit and inventory valuation, will make direct impact on the profits of the company. Net profit will affect the equity as well. Closing balance of inventory from year to year will also change. The company will make the calculation from 20x5, means 2005 to 15 and 16. For 10 years you have to do. The provisions further state that the company will adjust the opening balance of the equity and other related amounts for the earliest prior period presented. Underline. This is what they expect from you. If you can't write so much, at least write that you have to adjust the opening balance of equity and other related accounts for the earliest prior period presented. It means if the company is presenting account for 16-17, it need to give comparative figure of 15-16 also. Therefore, the earliest period presented will be FY 15-16 in the above mentioned case. Thus, the net effect on profit of last 11 years will be adjusted through the equity and inventory balance. So your inventory balance you upgrade and retained earning figure you have to adjust in the year 15-16. Thereafter the new policy will be continued, and every year the valuation of inventory will be done using the weighted average method. Now come to that paragraph 11 above only. Disclosure of accounting policies. What are the disclosures requirement? First is, on an entity on initial application of an IFRS is required to disclose the following. First time you are applying an IFRS, disclose the title of the IFRS, nature of change in accounting policy, and if transitional provision applies, its description and the extent of effect on the future period. The effect of change for each line item affected and the respective basic and diluted EPS. If retrospective application is impracticable, an explanatory statement for the same. Why you cannot do it? Okay, so you cannot just simply hide under this paragraph, impractical application. You have to give an explanatory statement justifying why retrospective application is not possible. These are the requirements on application of an IFRS. Sometimes the change in accounting policy can be due to voluntary application. In that case, these 5 requirements will be there. In addition to the 5 requirements, you have to also justify why you have changed the accounting policy and how it will lead to more relevant and reliable information. Once again, understand, these 5 plus this disclosure will be given if there is a voluntary change in accounting policy. Because in voluntary change in accounting policy, you have to inform your user why do you think this policy will lead to more relevant and reliable information. Now, one more interesting thing. Suppose an IFRS has been issued but is not yet effective. Issued but not yet effective. Are you supposed to give the effect in the financial statement? No. But you have to give some disclosure about it. Such fact, along with a reasonable estimate of the impact application of new IFRS on the entity's financial statement, is required to be disclosed. You are making our investor ready for the future, because you know that a new standard has been issued and it is going to get effective in the coming years. So you have to tell your investor well in advance, once this standard is effective, this is how our financial statement will be affected. It might give rise to more profit probably. It may reduce your profit also. Okay. So the standards on leases, standards on insurance contract, which may be issued but not yet applicable to you, can affect your future profitability. Okay. So at least inform your investors. Now you will see one small case study. During 20X2, Delta company changed its accounting policy for depreciating PPE so as to apply much more fully a component approach. We are going to take long lengthy problems, be attentive. So as to apply much more fully a component approach while at the same time adopting the revaluation model. So how many policies they are changing? 2 policies they are changing. First, they are following now a component wise approach. That means property, plant, equipment, instead of depreciating the whole property, plant, equipment using same rate, they will divide this property, plant, equipment into significant components, and if their useful life is different, 40 years, 30 years, 20 years, 10 years, then each component will be depreciated according to its own useful life. That is called component approach. Okay. Earlier they used to depreciate the whole asset using a single useful life. And the second change is, now they are going to shift from cost model to revaluation model. So this is a very complicated change. Okay. And is it a voluntary change or is it a change due to requirement of IFRS? Seems to be voluntary so far. In the year before 20x2, Delta's asset records were not sufficiently detailed. Oh. So there is a difficulty. Not sufficiently detailed means you have not maintained detailed record of components of each property, plant, equipment. To apply a component approach fully, because to apply a component approach fully, you need the data of each component also when you purchase that item. Now you can't do that. At the end of 20x1, management commissioned an engineering survey which provided information on the component held and their fair values, useful life, estimated residual value, and depreciable amount at the beginning of 20x2. So at the beginning of current year, all data they have gathered to apply this new policy of component approach and revaluation model. However, the survey did not provide a sufficient basis for reliably estimating the cost of this component that had not been previously accounted for separately, and the existing records before the survey did not permit this information to be reconstructed. Now some asset you might have purchased 10 years ago, 15 years ago. So you don't know at that point of time what was the value of each component because you did not prepare the records accordingly. Delta's management considered how to account for the two aspects of accounting change. Which are the two aspects? Component approach, revaluation model. They determined that it is not practicable to account for the change to a fuller component approach retrospectively, or to account for that change prospectively from any earlier date than the start of 2002. So this is the earliest date practicable. Also the change from a cost model to revaluation model is required to be accounted for prospectively because this is the requirement of IAS 16 itself. Revaluation model will be only applied prospectively. Therefore, management concluded it should apply the new policy prospectively from the start of 2012 or X2. Now you are given some additional information. Particulars: property, plant and equipment at the end of 20x1. End of x1 means beginning of x2. Cost 25,000. Depreciation 14,000. 25 minus 14 WDV 11,000. Prospective depreciation expense for 20x2 old basis 1500. If I continue with the old policy, depreciation will be 1500. Some results of the engineering survey. Now the fair value of this asset was 17,000. Estimated residual value is 3,000. Remaining life 7 years. So 17 minus 3, 14 divided by 7. How much depreciation will be now provided by this entity on the remaining useful life? 17 minus 3, 14, 14 divided by 7, 2000. You are required to prepare a relevant note for disclosure in accordance with IAS 8. Is it right? So what is the note you have to write? In the exam you have to write that note. You don't have to just show the calculation. You have to say that earlier the company had this policy. Now they want to follow the new policy. Explain the new policy. And then you have to also explain why the retrospective application is not practicable. Because engineering survey and the accounting record says You can't go behind the beginning of 2002. Okay. And because of that, you have followed the prospective application only. So you will write a note like this. This they have to disclose in their notes. From the start of 20X2, Delta Company changed its accounting policy for depreciating property, plant and equipment so as to apply much more fully a component approach while at the same time adopting the revaluation model. That means the same sentence which is given in the question, you have used it for justifying why you have followed a new policy. Management thinks that the policy provides reliable and more relevant information because it deals more accurately with the components of PPE and is based on up-to-date value. So this is the reason for change. This is the reason for change. Okay, this sentence you by heart because it will provide more relevant and reliable information whenever you change the accounting policy. And why it is going to provide more relevant information? Now you are doing component wise accounting. Since the life of different component is different, it will give you a better understanding. Plus they want to show the up-to-date value of the asset in the financial statement. The policy has to be applied prospectively from the start of 20X2. Now you are writing why it cannot be applied retrospectively. Because it is not practicable to estimate the effect of applying the policy either retrospectively, even prospectively from any earlier date. Accordingly, the adoption of the new policy has no effect on prior years. The effect on the current year is, now what are the possible effect in the current year? First is, understand what is the book value of your PPE under old policy? 11,000. And under new policy the valuation is 17,000. So one effect will be property, plant and equipment at the start of the year will increase by 6,000. Second effect will be contra effect. Revaluation surplus at the start of there will be 6,000. And depreciation in this year, which was supposed to be 1,500, will be 2,000 now. That is, depreciation charge will increase by 500 rupees. Is it right? So this completes part 1 of this chapter. Change in accounting policy. Yeah. That is, we will discuss in IAS 16. Additional depreciation of 500 rupees will be adjusted against retained earning. So for the current chapter, this much information is enough. Now we will continue tomorrow.